everybody. Welcome to Friday, another Talk Money with Tom show today. Really excited to try to help you improve your retirement, especially in a financial arena. And we do that really by answering your questions. You can send those in at any time. You can send them in now. During the show, we'll try to answer them live. Two different ways to send them in. Email, asktom@talkmoneywithtom.com, right there on the screen. Or if you'd like, you can put them into the chat here on the YouTube channel, and we'll try to answer those live. You can send those in during the week, so we get a chance to look at them. And then also, of course, we cover questions that have come up within our client strategy sessions during the week also, which we think might be useful for everybody to know about. You can subscribe to this channel if you'd like. We believe that the more that you know about these areas, retirement planning, asset management, tax planning, the better your retirement can be, even if you have an advisor. So you subscribe, and then you can hit the little bell button, get notified whenever we put new content on. You can continue to learn along, as our content grows. Or if you'd like, you can just meet with us. We have a book appointment button that's right in the corner of our website. And you can, hit that button and go ahead and go to our schedule, which is online, and be able to have, a time with Eason and I, 30 minutes or whatever for phone, video, even in office, to, cover what we're, maybe more important to you, right? Specific issues that you want to make sure we cover. So that's how it works. Really looking forward to today's show. I do always start off with a summary of what I saw happening this week in the stock market. It's been a soft couple of weeks here.
Yep.
Yeah. So what has it been? 4 weeks since we started talking about really the consolidation phase that we felt that was going to happen, mainly because we just had such a huge run up in a short period of time without any real consolidation. And really, I kind of outlined that here. So, there's a last consolidation phase and kind of the one that we're in now, as far as that goes. I would not be surprised for this one to kind of extend down to this 4,300 level, right where that other downturn kind of bottomed out. Probably should be some support there. If you look at the previous consolidation zone, it lasted a while, 6 weeks. And so here we are in the summer. August is generally normally a kind of a soft time for the market. A lot of the money managers are out vacationing and what have you, and such too. So, we'll see how this plays out this year as far as that goes. But nothing to be concerned about here. Matter of fact, as far as I'm concerned, when we look at the market as a whole, these little consolidation periods are critical. For me, what I see is if a market goes straight up, like it did in '99 and, the end of the 2000, it was so fast and so narrow. Sometimes the stretch gets so high to the upside that you kind of get this pullback that comes down really fast and scares people. And then you get this momentum, and all of a sudden you end up with a big downturn that might not have happened if you didn't have the big upturn. And so these kind of small stretch, take a break, another stretch, take a break. This is a very healthy market. And so it's doing exactly what it should be doing. Now, the thing that always amazes me is how the news gets attached, because essentially if you look really closely, almost every day there's some portion of news where it was negative for the market and something that was positive for the market. If it's a down day, we hear about the negative news, right? And if it's an up day, we hear about the positive news. But this news is existing, and really it has not so much to do with what's happening day to day, although that can have an impact. It's really just kind of that supply and demand, right? And so when you have so many buyers that have already come in and stretched that market upward, you kind of get this scenario where, they're exhausted. And now you kind of have more sellers that are sitting there, it could be the same number of sellers, but on a relative basis, the buyers have stopped. And so it kind of comes back down, gets to a level, maybe that green line there at 4,300, where people say, wow, I really wish I would have bought it back then. And it gets there again, and they start to buy again. And so
people look for the deal.
Yeah, and things are on sale compared to where they were. And, hey, I wish I would have bought XYZ stock at that level, and now it's back there again, and I'm going to buy some. And that could be professional money managers or what have you. So the big news this week is just some of the inflation reports that have come out. Let me switch up views here so we can see this a little bit better. There we go. Okay, so this is the consumer price index, what they call the headline inflation number, which just means it includes everything in the basket. And you can see on a year-over-year basis, so this July versus last July actually went up a little bit. We're at 3.2%, and we were at around 3% last month. And so, some concern there, but I'll show you why I'm not concerned about this at this point, because that actually has more to do with what was going on last July than what's happening this July. Core consumer price index, CPI, year over year is at 4.7%, and it's actually down for the month, right? So core just means we took out food and energy, right? That's important. As far as the Federal Reserve goes, they look at core inflation more. It's why we keep talking about it, because really, with inflation, there's two different ways to look at it. One, as a consumer, right? As a consumer, we just want things to be less cost.
Yeah.
However, there is a limit to that. We don't want, for the market itself, if we get into a deflationary environment where costs are coming down dramatically, that's actually a bad thing for business. Very difficult, because whatever they produce now, they can't make as much on because it's selling for less. And so deflationary environment is actually worse, but we're trying to get this back down, okay? So CPI is not the key measure that the Federal Reserve looks at. They look at PCE, personal consumption expenditure. That comes out at the end of this month for July. But here's core CPI month over month change. So in this case, we're looking at this June to this July. And so it's hard to see that, but it's exactly the same as it was last month. So from May to June and from June to July, it's at 0.16% a month.
Which is great because, if you put that for a year, that's just a little bit above 2.
Actually, it's 1.94%. But exactly. So again, they're looking to trying to get PCI down to 2%, PCE, sorry, down to 2%, not CPI. But this is already at 2% if we keep going at this level, right? So that's really important to understand. Now, annualizing out 2 months worth of data might be a little bit of a stretch, right? Lots of things can happen, but that is the best 2 months we've had if you look back till that last couple of years. So that's good. And actually, the market responded positively to this when this came out, and I think so. Rightfully so. I mean, it was up almost 1%, and then by the end of the day, we were down to 0.
Yeah, and a lot of the actual increase was from shelter.
Yes.
Which was 0.4 month over month.
Yeah,
so
exactly.
that was like a big bulk of it, and a lot of people saw that as positive.
Yeah, and actually, partly because the way that they calculate shelter in CPI is very unusual.
It's lagging.
It's lagging for sure. And matter of fact, that's the big criticism of. And what do they call it? Super core now, where they take out shelter because it's just it's a wacky number. They actually assign owner's equivalent rent. So even if you're not renting, they basically try to guess how much it would cost to rent your house.
Yeah.
There's a whole bunch of other details in that aspect that are really kind of fascinating. But nonetheless, CPI I thought was really good. And then today we got the PPI number, the Producer's Price Index. And so this is the wholesale prices, and so look at wholesale prices. They actually jumped quite a bit year over year, 0.8%. It was almost at 0, and so market responded negatively to this morning. But to me, I look at that and say 0.8% over a year. That's way below the 2%, and so it's bound to bounce back up. And it was a big bounce, but it's too low as far as I'm concerned. If we look at core is actually, when we take out food and energy, wholesale inflation is down to 2.3% year over year, and that's actually down for the month. So I think that's good. And if we look at though month over month change, it's at 0.3. And again, if you annualize that out, that's 3.6%. So that's what the market's reacting to. However, to me, that 0.3 has a lot to do with last month, which was actually deflationary. It was down. So I think this is just a little bounce back. I would not be surprised to see this measure back out again down to that kind of 0.2 range or what have you next month. These are all a little bit volatile, especially month to month, but the market kind of responded to that, right? So that's what's happening as a whole in the inflationary environment. And again, one of the things that's really important to understand about inflation, at least in my opinion at this point, is really what's driving the market. Because when the Federal Reserve is raising rates, the stock and bond market has a really, really hard time doing well, right? And when the Federal Reserve is not raising rates, the market can do fairly well. And when the Federal Reserve is lowering rates, the market can really go, right? I mean, everybody asks me about, what's going to happen with the new presidential election or what? the Federal Reserve Chairman and the Federal Reserve Board are much more important to understand if you're going to understand investing. Now, the president does get to pick some of these people, and so Chairman Powell actually was chosen by Trump administration, and then was kept on, throughout the time frame. There's other board members that vote and what have you.
Yep.
And so there is some impact there. But so if we look at, kind of that aspect of it, you can see something different here, which I think is interesting. And so the market basically has a futures mechanism to basically have probabilities for what the Federal Reserve is going to do in the future. And this is called the CME, Fed Watch tool. Now, the Fed keeps talking about the possibility of another rate increase this year.
Yep.
And they come out and, they have a vested interest to come out and say they're going to raise rates, even if they're not, because it does potentially slow down the market. Because one of the things that creates a higher inflationary environment is more money. And so if everybody feels richer because the market's doing well, then that can have an impact. 88.5% chance right now that the rates stay the same. So it's 5.25 to 5.5 is where we're at now in the September meeting.
Yep.
And this is after the CPI and PPI reports, all of this. So again, if you really want to understand what's happening here and have some confidence in what might happen in terms of the market, it looks like the Federal Reserve won't be raising rates here anytime soon. Because if you go forward, November, 3.8% chance that it stays the same. And then December, 59.8% chance that it stays the same. Actually, a very small 8% chance that they drop it.
Yeah.
But so that's different than what the Federal Reserve is talking about.
Yeah, and the thing with inflation that we have to remember is you don't want it to be dropping too dramatically because that means you're heading for a recession.
Yeah.
So you kind of want this slow descent down.
Yeah, exactly. The curve that we're seeing on top line inflation is a really good curve to me. And within the CPI and actually the PPI top line, pretty much the same. And so, yeah, the shape of that where it's kind of peaked out, last June, July, and then it's kind of come down pretty consistently. I think the Federal Reserve can say to themselves, hey, this is the time we can wait and see what happens. We've raised rates a lot. There's a slow impact to when those rates actually hit the economy. So, anywhere from 3 to 18 months, depending on what part of the economy and who you're talking to. And so, let's see how this plays out. There is this fear within the Federal Reserve, and they've mentioned it several times, at least Jay Powell has, of a reinflationary situation like they had in the late 70s. And so they kind of backed off. They allowed, interest rates to kind of settle in, and they actually lowered rates a little bit because the job market was getting a little softer. And we are seeing some softness in the job market a little bit. We're seeing some higher first-time unemployment claims for the last few weeks. Nothing substantial, but higher. So, and then all of a sudden in the late 70s, inflation got out of control, and they came in and they got here we are at 5.25 to 5.5. They got the Fed funds rate up to 19%.
Yep. Which
honestly I can't even get my head around. I believe in somewhere in there they had a 3% increase at one meeting or something really crazy. Because how do you get to 19? You can't do it at a quarter point at a time. It takes too long. So they were trying to really just knock it down. It worked. This was Volcker, and this is kind of the model that they look at now. But that would be, very difficult to deal with. So I do consider that as one of the things we really want to keep watching is this inflationary environment. And I'm very pleased that the market and these futures, reports have been more accurate than the Fed at predicting where rates are going to go. And so watch these and you get some kind of an idea of where things are going. And so, the rest of this year, things are looking pretty well. Most of the analysts have taken recession projections off the table for 2024. I mean, how many months is 4.5 months left or something, right? So that's an easy call for me. But yeah.
Yeah, and also the Fed's kind of forced to take a break for the next month too, because they're going to have their Jackson Hole meeting instead of an actual regular meeting. Yeah,
and matter of fact, they don't have an October meeting either. If you saw that, we got the September meeting, and then we got November 1st and the December, I think, 13th or 12th. And so that there's only 3 more meetings. I'd say that, unless something really strange happens here, I don't see them raising rates for the rest of this year either. And the only thing that can really move inflation fast is energy price spikes, right? That was one of the things that happened in the 70s. And that's something the Fed worries about too, because they don't feel like they can really control, the cost of oil. Something happens in the Mideast or Ukraine situation or something, and all of a sudden oil goes to $200 a barrel or what have you. And that was the fear during this. They can't really control that. They can try to tamp down demand in general, but the problem is that oil and gas goes through every part of the economy.
Yeah.
Your food, it's not just the gas station that you're paying more, it's everybody's paying more for that gas and diesel, and it all ends up being part of the product costs. They go to Target, they're having to deliver that stuff into that store, and so transportation costs can go up a lot, and that gets passed along in some of those. You can buy, a piece of clothing at some store and have a higher cost because
There's some fear with the OPEC cuts and the continued production halting. Right. That there'll be an increase in energy costs.
Yeah, and I'm surprised that it is as low as it is, to be honest, because we're in the middle of a pretty good resurgence. I would say the one kind of outlining thing that's happening here is China's one of the biggest consumers of energy because they produce so much. And we just got a report this week about their exports being, way below expectations. They're actually experiencing deflation, which is not a good situation. But the advantage to the global community at the moment, if there is one, is that if the second largest economy in the world was hot and really going, that would be a real big push on oil and a big push on a lot of other things. And so our inflation here and around the rest of the world is probably somewhat moderated because China hasn't really caught on. And that could be a good thing. So theoretically, ours kind of slows down, our economy maybe slows down enough to let everything go, and not just here, Europe, around the world. And then China finally does get going. That could kind of keep us into that, soft landing zone, right, in theory, because it has been one of my fears that China gets hot along with everything else, but it hasn't happened yet. So it's not. I think that's good for the market at the moment, up to a point. So we'll see how that goes. But
so, what are our signals for the week?
Yeah, what are signals for the week? We have some changes on the bond portion, but we're still at yellow on our fast signal for the stock market for obvious reasons. You can see, when you head into these consolidation zones, the markets come down a bit, and so a little caution is advised. New money coming in right now. We're sitting on it. We're waiting. Yeah. And just make sure that this consolidation zone isn't a new downturn. And probably, you fall through that 4,300 barrier. We might be heading for a newer downturn because we're starting to set some new lows, and lows are, subjective as to which one should really count. But nonetheless, there's a little bit of caution as far as that goes. But long term, the slower signals certainly still up. But if we look at the bond market signals, those are both red at the moment, right? And it flashed yellow yesterday, came back to red today. And so this is interesting because this should be more on the green-yellow side, because the stock market is, and the bond market tends to do similar things. The Federal Reserve is cutting back on rates, right? We should be seeing better scenarios on the pricing of bonds. But the bond market does have one unique thing going on right now, and that is that they're having to issue an awful lot of treasuries, right? And so the market is absorbing. It's actually going pretty well.
Yeah.
Altogether, I think better than expected, but we're having a massive amount of new issuance of bonds just because the government has to catch up from that period of time they were using extraordinary measures. We hit the debt ceiling in February and couldn't issue bonds. And now we're having to kind of pay all that back for that period of time because they were borrowing money from pensions and different extraordinary measure areas that need to be replenished. And so they're slowly but surely issuing kind of, more bonds. We talked about that last week too. So nonetheless, that's what's going on this week. Really appreciate everybody kind of watching, the summary here. Look forward to being able to talk to you again. However, we will not be here next week. I'm actually going to be out of town. So we'll be here in 2 weeks to cover another summary as far as that goes. So thank you. Okay, so let's take a look at some of the questions.
What are the rules for RMDs, required minimum distributions, on inherited IRAs?
So RMD rules, okay, so this comes up a lot. Yeah, and rightfully so. Required minimum distributions. I mean, I'm going way back here, but back in the 90s, we used to do seminars, and it was the most talked about concept, mainly because if you don't do it right, the penalty is 50% of what you're supposed to do. So if you're supposed to take out 10,000 and you don't, it's a $5,000 penalty. So people worry about that, rightfully so. I've never seen anybody pay the penalty, even for some people that didn't do it right. But nonetheless, it's why it motivates people to look at it. And of course, they keep changing it. I can. There's dozens of changes that have happened since the 90s. So if you have a beneficiary inherited IRA, so this is one specific area of the required minimum distribution rules. And if you're a spouse, right, and you're the primary beneficiary, really easy. Yeah, you can leave it as an inherited IRA or just move it into your own IRA. Oftentimes we see people move it into their own IRA just to make it simpler and keep it in one account. And so that's pretty straightforward. If you're not a spouse, that's where it gets more complicated.
Yeah, so there's basically 3 categories you fall under. You have your eligible designated beneficiaries, which is your spouse. If the inheritance is going to a minor, someone that's under the age of 18, or a child that's a minor, your child that's a minor, and then if the person is also within 10 years of your birthday, so basically a lot of times it's a sibling, is one of those people, or it's going to someone that is chronically ill or disabled. And those are kind of those where you're allowed to stretch it for a lifetime.
So minor, 10 years within your age, or disabled, right? Those 3 categories are unique within this particular law. They inherit an IRA. They can stretch that over. What they call a stretch IRA just means that you can use the tables that the IRS has, look up your age, and then there's a factor. You divide that into the value at the end of each year. It tells you what you need to take out. If you look closely at that table, it goes all the way out to, I think, 120 now.
Yeah.
Right. And so you can basically slowly but surely take money out of that retirement account for the rest of your life. One exception, though, is the minor.
Yeah.
Because once the minor turns 18, then they have they fall into the other rules. Okay. So that's one classification, right? And so what's the next classification?
Next one, you have the 10-year rule, and that's generally everyone. It's essentially anyone that is an individual. So I give it to a friend that's like 20 years younger than me. Okay, they withdraw it in 10 years.
Or a child, right?
Yeah.
Who's not under 18.
Yeah.
So this is basically anybody that is not under 18, not within 10 years of your age, and not disabled, but they are an individual, not a trust, right?
Yeah.
They have to withdraw over a 10-year period.
Yeah, and then there's the 5-year rule, which is kind of trust and estates.
Right.
So that's where it kind of gets wonky, where it's not an individual.
Right.
And so that's why trusts are the weird one. They can fall in a gray area. So sometimes a trust could be a lifetime stretch, could be a 10-year, could be a 5-year. So you have to really work with your state attorney or and tax advisor to make sure your trust is set up properly.
Yeah, exactly. We don't see as many trusts. Again, they can get kind of complicated, but there are certain situations where it definitely makes sense. The most common group is the one where we have this 10-year distribution. And so there's some complications in there also. So essentially, at the moment, there is no requirement to withdraw anything until the end of the 10th year. So this is one misconception too. So let's say you inherited this in August of one year. It's not by the next August 10 years later that you have to withdraw it. It's actually by the end of that 10th year, December 31st. But what I'm worried about is that somebody has a fairly large IRA and they don't really understand the rules and they're just leaving it and letting it sit there. They're not taking anything out. And then all of a sudden in that last year, they have to put $1 million or whatever it might be worth by the end of that 10th year on their tax return. And so much of that's going to be at such a high rate.
Yeah, and so the IRS kind of understood this in a sense, and so they had this proposed rule in February of 2022, where you would take out, if the person that was deceased had RMDs, you would also continue RMDs based on your life expectancy, right. And so you would take 9 years of RMDs, and then the 10th year you would have to distribute the rest of the IRA.
Right. So you inherit this, let's say, from your parents. They're already taking the minimum distributions out, right? you have to keep taking minimum distributions out. Now it's based on your life expectancy,
Yeah.
so it's a smaller dollar amount at the end of that 10th year. Uh, but that's been
So essentially,
delayed, right?
no one knew this, and so a lot of people are playing. Oh, well, just some people are playing because you can time it, control your income using that IRA. People are playing. Oh, I'm going to retire in 5 years. I'll start taking then, and so the IRS has waived 2020 and 2021 and 2022, and now in July they announced they're waiving 2023, and then 2024 they said they'll have their official announcement, but they could wait for another year.
So far, there's no requirement
Yep.
to take out anything. There should be a requirement, and I don't know why they're messing around with this. Obviously there's a knowledge issue, but usually they don't allow that to be. Ignorance is not usually a good defense when it comes to taxes. So because here's my concern, and here's what we're doing within our practice, is I want to make sure that we're not getting a massive surprise for the beneficiaries of these IRAs. If it's really small, then it doesn't matter. If it's a $10,000 IRA or something, that's not important. But if it's 300,000, 500,000, 3 million, whatever it is, that could be a huge problem at the end of 10 years because it's all taxable income that has to come out. So what we've been doing is essentially, at least on a basic basis, recommending that the first year you get it, you divide by 10, take that much out. Then you divide by 9, 8, 7, 6, 5, 4, all the way down to the last year you divide by 1, means you take the rest out. It kind of evenly distributes more or less the money over that 10-year period. And then what we want to do is just make adjustments sometimes to that program. So 1 year comes along, wow, I'm going to have a lot of income this year. Maybe you don't take it this year and you double it up the next year, or just the opposite. I've got really low income this year. I'm going to take more this year and less later. So you can make some adjustments within a tax planning strategy there. But I would recommend, starting to take an even amount out. There's other things happening too that people just aren't talking about. But 2025, the current tax rates sunset, and they're better than the previous tax rates.
Yep.
And so if Congress in 2025 somehow isn't aligned to a point where they can say, okay, we're going to continue these, we're going back to the old tax rate. So I would still be wanting to factor that in and maybe having a little bit more coming out of those beneficiary IRAs prior to 2025, just because there's a possibility that after that I might have higher tax bracket. So these are things, again, there's the stretch concept where there's 3 groups that can kind of stay in there, some spouse, somebody within 10 years of your age, somebody who's disabled or a minor up until age 18, they can use the tables and stretch that out. We've got this 10-year rule for individuals that don't fit in those, other categories. They have to take it out over a 10-year period. And then, of course, we have the trust thing, which is convoluted, but it could be 5 years.
Yeah.
And actually it could be 10, or it could be stretched all the way out. So it depends on the trust. But nonetheless, most of the people are kind of in that 10-year category and being able to do that. Now, again, if you inherited the IRA prior to the end of 2019, none of that matters. There was no 10-year rule.
It's a stretch. And these are all minimum requirements. So
Yes.
you can always take more if
Yes.
you need to.
Right.
But this is the bare minimum you would have to do.
Yeah, and my fear right now, there is no requirement to take out anything. And so we got people that are going to be very surprised at the end of this 10-year period because they just don't realize what's happening. And so they end up with this big chunk of money that ends up on a tax return. So if you have kids, make sure that they kind of understand how the inheritance of your large IRA is going to play out, and maybe have them talk to us, for example.
Yeah, and I was looking at some of the major companies that handle like IRAs and stuff like so. And Vanguard explicitly says on their inherited IRA kind of informational that they don't provide any kind of distribution services or something.
Right.
So you have to do it yourself or talk to your tax advisor.
Right. Yeah. Exactly. They don't want the liability. We've been helping the clients doing that 10, 9, 8 calculations and calling them up or emailing and say, hey, we recommend you take out X amount this year to kind of even things out all the way across the 10-year period. So, yeah, just be careful there. So, good. So that's a great question. Thank you for asking that, and we'll hopefully cover that, I think, in pretty good depth. All right. What's our next question?
How does the ballooning credit card debt and the starting again with student loan repayment affect inflation and just the general economy?
Okay, so we have credit card debt. Good thing for the economy, right? It's
To a certain
spending
point.
up to a point, and but this is exactly what we were talking about for the last years. We've been talking about this pent up demand. The last pandemic created the Roaring Twenties. Uh, Money was inexpensive. A lot of money got pushed out there. Companies are looking to put it somewhere. Banks are looking to put it somewhere. Credit cards, they make good money on credit cards, even with the
Yeah.
bad debts and the fraud. They're charging high interest rates at 12+%, and so and mortgages, were really scary for banks and a lot harder to do after 2008's disaster. So lots of money available for credit card. So that starts there. The banks have to have that available, and that's been flowing. And so people are using that. And that's good for the economy up to a point, right? I mean, we'll see. I think we're pretty far away from a point where it's not good for the economy.
Yeah, and so credit card debt, I think the reason it's in recent news is a trillion dollars of credit card debt for,
We.
and so it becomes detrimental when people start to tighten their belt, essentially stop spending.
Right.
They have to pay more to their credit card debt,
That's right.
and
Yeah.
that's where it kind of snowballs downward.
That's where it's kind of like a whiplash, because it's a big jump for the economy, and then everybody gets too far off on the credit, or somehow it starts becoming restricted because of economic situations, regional banks having trouble, or whatever it might be, and then everybody starts having even less money than they did prior because they're not spending credit cards; they're actually paying on the credit cards, right? So that kind of relates to the student loan. So if they're not paying for student loans, that's good for the economy, right?
Yeah.
And there's a lot of that money comes back in potentially into the economy. If they have to start paying on student loans, that is a drag on the economy.
Yeah, so there's 43 million people with federally held student loans.
Wow.
And then I think a lot of the private, loan companies are also following kind of that same pattern of when public or the federal loans go into repayment, so do theirs. And
That's
so it's going to be heavy.
that's a lot of voters.
Yeah.
That's why this is such a political football. And you can see why the current administration is trying to appease those voters with some of these relief pieces. Now, there are an awful lot of stories out there with kind of predatory practices on some of these loans. Some of the
Yeah.
interest rates are ridiculous, and so there's probably some legitimate reasons to do some
It,
relief
it,
also.
it's a pretty big drag for a generation if they have too much debt because
Right.
it puts off a lot of their life events. So buying a house, having children, so it kind of everything gets pushed back if you have too much debt, and so it's kind of that balancing act.
I saw analysis once on countries that have, mortgages on homes versus countries that don't, and the appreciation on homes, of course, was much higher on countries that had mortgages, right? So if you take that to university cost and college cost, I think that's part of the driver for college costs. When people can borrow money fairly easily, in a lot of cases, to pay for college, colleges start charging more. That it's available money
Yeah.
that comes through. And so I've never been a really big fan of student debt. I know it's somewhat necessary, but I've seen some pretty tough cases to deal with.
Yeah, I think it's also kind of you sometimes have to think about student debt as kind of like an investment.
Mhm.
Am I going to get a good ROI on this student debt? So, may if I'm going to become a doctor, yeah, I'm willing to take on that debt because I have a
Yeah.
higher income
Right.
payoff with that. But maybe if I'm becoming a writer, maybe it's I should take a smaller debt burden.
That's right. Yeah, exactly. Where your income is less certain going forward. Yeah, no, it's an interesting area altogether. But I do think that repayments will be somewhat of a drag on the economy as people are paying those back instead of.
It could help with inflation though, because if people
Yep.
have less money to spend,
Yep.
inflation will come back down too.
That's right. Yeah, and there's always that side too. That's the funny thing with inflation is actually the good news is bad news and bad news is good news, for inflation. So unemployment goes up. Well, that's bad news, not for inflation, especially to a certain degree. People start having to pay back their credit. That's bad for the economy. Well, not for inflation, right?
Yeah.
So yeah, and we're in an inflationary environment, and that's where it gets kind of confusing. But it's really it's pretty straightforward when you really think about it. All right. So what is our next question?
Should I ever move a portion of my dividend stocks into CDs or treasury bills?
I move a portion of my stocks that I have in dividends to CDs or T-bills. So I already have some dividend stocks, and I'm thinking of selling them. I would not sell them to move them for pure yield. In other words, how I'm getting 3% on my dividend stock, and now I can get 5% on that CD, so I'm going to sell my dividend stock. Mainly because I have a chance on the dividend stock of making some appreciation also. Stock market average is what, 11% a year. Dividend stocks generally are lower, because they're higher dividend. That's why they're higher dividend usually. And so I wouldn't sell a dividend stock purely to buy a CD or T-bill just because of the higher rate. I also have the option of reinvesting into that dividend stock, and if it does eventually appreciate, now I purchased a bunch of shares too, so that's kind of nice. Can't do that with a T-bill or a CD. So those are, I think, interesting. However, let's say that my dividend stock isn't doing well, and I do want to sell it, and now I got a choice between going back to dividend stocks, going to CDs, or going to T-bills, right? I could make an argument for being in CDs and T-bills in that scenario where I was going to sell it anyway and maybe not being back in dividend stocks. But I don't know. It kind of depends on the overall balance of the portfolio. I already have a bunch of CDs and T-bills, and the dividend stocks is a category. And I'm putting money there in that category, and now I'm taking it out of that category and overloading another one. Or I have a ton of dividend stocks already, so I'd say the balance of the portfolio has to be factored in there. But ignoring that and just looking at it as a sole piece, I'd consider it. Yeah, this is not a bad time. And we have been talking to clients about the CDs, and we've set up a bunch of CDs for people too. And I'm telling people now, we were talking short term before, kind of 3, 6, 12 month type thing, just because we felt rates were continuing to come up, and we were right during this period of time. I'm now saying, hey, you might want to go a little longer, because rates are starting to slow down. We just talked about during the summary of the, for the week, that the rates, probably won't go up from the Federal Reserve, in my opinion, for the rest of the year. And so, if you can get 5+%, maybe locking that in for that 12 months, 18 months, that I'm not go super long, because inflation's a weird animal and it could rear up again, and all of a sudden we could have higher rates coming. So I wouldn't go out 5 years or something. When it gets to 10%, I go 10 years. I had a client come in once with a 10-year CD. It was so cool. He had money in there that he had to put back in the, late 70s and early 80s. And that was a brilliant move. So if it gets there, go long.
That's when you're getting to the average of the actual stock market.
Exactly. On a guaranteed basis. That's pretty cool. So, I'd back up the dump truck of money and buy those. Which is why the stock market hates high rates, right? That's it. If the average rate of return is 10, 11, and all of a sudden rates start getting closer and closer and closer to that, why would you buy the stock market when you could make, when you could make 8, 9, 10, 11 or whatever, So that's why the stock market hates this. All right, good. I think we have time for one more.
Could Country Garden and the China real estate issues spread to the global economy and cause any kind of downward effect?
So Country Garden's a very large real estate developer.
Yeah, right? They're expecting $7.6 billion of losses.
Holy mackerel. You keep reading articles about China's real estate situation. First of all, the amount of leverage, just in general. I read a great article talking about how, part of that is because there's not as much confidence in the stock market, and there's confidence in this hard asset. And so even individuals are buying properties, and leveraging them, buying more properties. But these big companies, these big real estate companies, what was the name of the one that had 300 billion that was in trouble? Not Evergreen, because that was
Evergarden.
Yeah, that's what. And they were in the news last year, $300 billion worth of debt against properties. So here's how I kind of look at that. Can that cause problems for the world economy? Yes. You bet. This is the second largest economy in the world. If they fall apart, we're not going to avoid that. Believe me, nobody is. And so if there's big problems there. But here's what I would give as an example for why it might not be a problem. If we look at what happened this year with Silicon Valley Bank and Signature Bank and First Republic Bank, all the way through this downturn that we were having last year, we were talking about when you raise rates this much, something can break. 2008, Lehman Brothers broke. Actually, several things broke, but they were bailed out until they got to Lehman Brothers, and then they let it go. And it was a house of cards that just collapsed, and the stock market dropped 30%. If Silicon Valley Bank was just, and all those regional banks that were struggling were just allowed to have capitalism run its course, we would be looking at that same 30% downturn right now. We would not be talking about how great the markets are. So what happened was two things. The government stood up and said, hey, we're backstopping the depositors in that bank. So even if you have more than 250, you're okay. We're going to cover that. That settled things down in terms of the capital flows that were happening. They let the owners of those bank shares go out of business. Poof, zero. They let the owners of the bonds in those banks go out of business. So it wasn't a bailout. It was a backstop. So that was kind of cool. But then they also set up a special group where they said, okay, if your bond is going to mature at $1,000 and it's now worth $700, if you give it to us for collateral, we'll lend you the money against that bond at $1,000. And that was a huge, I think it was 154 billion in like one weekend was borrowed out of that facility, and it brought this capital into the banking system that stabilized. And we're no longer talking about the regional banks, although it did come up this week with a couple of downgrades. But nonetheless, it's not as big an issue as it probably should have been. So my analogy there is that China is going to have some of the same issues. They had some bad numbers this week. Really low exports versus what was expected. They have deflation. That's bad. That's really difficult to deal with from a business standpoint. So they've been lowering rates and doing some stimulus programs. But China has the same capability that the U.S. does to kind of do these bailout, stimulus, support programs that the U.S. can't. And I think there's even more political will to do that. When they let Lehman Brothers fail, we had a regime change. We had a Republican White House that went to a Democrat White House. This White House now is not letting that happen as we head into 2024. And the same thing's happening in China. They don't want a regime change either. It would be a lot different than ours. But nonetheless, the economy there is very important to the kind of stability of the political situation. So I think that there's some support that comes in. Now, that doesn't mean that you don't have, downturns a little bit, at least before that support fully comes in. But as you were mentioning too, when we were talking about this earlier, they can maybe move faster than we can.
Yeah, their political system is a lot more centralized, and so you can get something done a lot quicker. That's why their infrastructure was built so much quicker than when you compare to the U.S.
Yeah, what I think I remember they were going to try to get to climate, zero carbon footprint by 2060, 50. I can't remember what it was. And they don't have to go through Congress and get the votes and get the bills. It's kind of just do it. So they have a better chance of doing that. And so I do think that they have that ability to kind of bail themselves out. And if you look at 2008, I think, and again, I'm guessing here to a certain degree, but I felt at the time that they did the best of all the countries in terms of those types of support programs that came out. And they came out of 2008 a lot faster, I think, than the rest of the world did. So they have that capability here, I think, because they still have the second largest economy in the world. They still have a currency that is, respected, and, they can sell their treasury debt to borrow money to basically support, which is what we're doing, right? I mean, these programs that we created for these regional banks, it didn't come out of thin air. We're already running a deficit. So if we're putting out more money for those things, then, we're going to have to issue more bonds to make that happen. But we can, because people like our bonds. I think China is still in that same category, not like the U.S. By far, but I think there's some capabilities there. They are being pushed by the U.S. financially, right? We're seeing, hey, you can't use these AI chips from American companies. You can't sell these Chinese stocks on American exchanges, or even Americans can't invest in them at all. That was this week's thing. I do think that kind of puts them on their back foot. My fear there is the Taiwan situation. Do we keep pushing them too much, and then they end up invading Taiwan because they need, capital and resources and what have you? So we'll see how that plays out. That's a much bigger threat to me than what's happening with their real estate sector right now. I think it's a problem, but I think that they could bail that problem out. Taiwan being invaded is a problem that none of us could probably figure out what to do other than, take cover, in terms of this, in terms of the market. So anyway, that's what's happening here. Really appreciate everybody watching the show this week. Again, we will not be here next week. We're going to be out of town, or at least I will be in. We'll be here in 2 weeks. But please send in your questions. Send them an email. Ask Tom at talkmoneywithtom.com. And we'll try to answer those in a couple weeks. Of course, subscribe to the channel. Continue your education. If you watch today's show, hopefully you picked up some things. There is 1,200 videos on our channel. There's something on there that can help you right now. You can subscribe as we put out new content. And we're going to be making a really big push this fall to put out some really good content that we're working on now. So, and then lastly, of course, you can always set up a time to meet with us. And look forward to, have a chance to meet with Easton and I and talk about your specific situation. You do that by book appointment button right on the top of our website, and we can take care of you. So look forward to being able to talk to you in a couple weeks. Thank you very much for watching today.